Okay, guys, 26 to 30, last set of questions. I hope you've had a good punch at these. These are all cash flows, but really, again, it's all double entry. So it says what should be recorded in the statement of cash flows for dividends. Right. So where are we? Here we are. So it says here, so we can look at this and see. So we have retained earnings and retained earnings here. So if you look at your, whether I use a T account or statement of changes in equity, really, if I look at this way, I have 8824 and I have a carry down figure, and this is all cash flows are about that you need to remember, carry down figure. So in terms of dividends, I'm told that I have a profit for the year of 627. So I have 627 coming out here. Technically, if I kept all of that, that would mean that I would have a high carry down figure, but I must have paid out some dividends, right? Otherwise, I would have that's why I have a difference. That's why all that's carried down is not made up of my opening balance and my profit for the year. So it means that my dividends, whatever went out, whatever I paid out as dividends, right? Divvies going out of the bank. Divvies. X must be the 8824 plus 627 minus 8951, which is 500. So I must have paid out a dividend of 500. So that's why the answer is A. Right. If you look at it from a statement of changes in equity point of view, you have retained earnings, opening retained earnings of 8824. Then if it's payout, well, we know what the profits are, 627, pay dividends, and have your closing, which is 8951. So the question is, what is that? It's opening, profits, take away dividends, and you have your closing. So that's what we've just done using a T account. Right, great. Great, so this is 27. Right, in terms of tax paid during the year, we literally just plug in all the tax figures, deferred tax, and current tax. They're all connected, and just literally just do our T account, if you like. So we have carried down figures to start the year of 108 and 250. We're told that the brought down figures, actually let me use a different page. So I have 108 and 250, and I'm told that the brought down figures, if you like, are 234 and 300. And then I'm told the tax year for the year is 672. So it's definitely debit tax, right, of 672. Credit, if you like, the tax liability. So it means that we must have paid the difference there. And when you do all these three minus this, you arrive at 496. At 496. Right, and that's B. So for 2028, the issue here really is to do with it's just mapping, making sure you pick out all the figures that you need, right? So if you look, let's look at what we have, what information we have, and it's literally just draw T account and just walk through the. We have some additional information to help us. So I have that as my final closing. It says that we got rid of that. So I mean, literally, you're just literally plugging in figures, literally. So just doing it over here on the slide, I start off with 13,918. Then it says I finish with 16,104. Then it says that I got rid of this thing that had a carrying amount of 965. And depreciation charged during the year, they tell us, is 2395. It tells us that we acquired some assets using a leasing agreement, so we recognize as assets these assets as if you like debit non-current assets, don't we, and credit the lease. So really the question really is that if you like, fundamentally we must, for anything else, we must have paid in cash, and that's what that is really ultimately, because this is my carry down figure. So doing that, you should be able to find that figure, and if you do all that, you will get your answer of 28. You'll get 4586. You literally just need to do a T account for these cash flows. Great. And then 29. Where are we? Let's say 29. Great. So question is, which of these statements are true regarding the cash flows? Depreciation is always added back, of course, to profit from operations, if you remember. And any loss on disposals should be added back as well. So not deducted, added back. If you remember, we have profit from operations. We add depreciation, disposal, and then we deduct any gains on disposal. Then we have to deal with any word. Yes.
Okay, sure, I'm quite happy. Are you with that?
Oh yeah, come in. Sorry, I was just doing a recording. It's okay. So you're right. Okay. Sorry, a colleague of mine has joined me. This is literally the last. These are the last two objective points. Armstrong, loss on disposal has to be added back. And then, of course, remember this whole business with trade receivables and trade payables and closing inventory. So, yeah, where was I? So we need to, it's statement 1 is the only thing correct. Great. And then finally, what describes the current treatment for payables made in relation to lease liabilities? And really here is that lease liabilities, the liabilities are really at active financing. They're a loan in effect, aren't they? They're a loan, if you like. And it's asking about the liabilities and the interest, of course, paid in the operating activities. Cool, great stuff. Cool, and that's that. So please go through all of these, and I'll issue out the next mock to work through.